It's the most wonderful time of the year. Things are going to get busy, but put down that eggnog for just a second. There are a few smart financial moves that may be right for you, and if they are, you need to make them before year end. They fall into four categories: health benefits, your portfolio, taxes, and retirement planning. I'll take them one at a time and just hit the highlights, but if you'd rather get them as a checklist, just pop over to focusedwealthadvisors.com/10smart. That's focusedwealthadvisors.com/10smart. Let's start with health benefits. If you have a flexible spending account, that's a use it or lose it kind of proposition. If there's money you've put into it that you haven't spent, now is the time to use it up. Refill any medications you've got for the next 90 days or so. Get any checkups that you can schedule before year end. I just saw my chiropractor for my quarterly adjustment last week and saw my dentist not long ago. If there are any medical devices or appliances you need, use your FSA to get them now. I had an FSA a few years ago and was having back trouble. Unfortunately, I spent a lot of time at my desk, which wasn't helping. I got my doctor to give me an order for a fairly expensive new office chair, and I was able to use my FSA to pay for it. This is re-enrollment time for many health plans. I apologize if you've already made your choices, but here are some things you can think about if you have not. Are you enrolled in a high deductible plan or a more traditional plan? There are a few things that go into the decision of which plan to choose, but here's where you start. How much do you typically spend on healthcare in any given year? If you have a chronic medical condition or you end up consuming a fair amount of healthcare in any year, a traditional plan is probably best. If you're young and healthy and tend not to spend very much, a high deductible plan can save you a bunch of money. Go back and take a look at how the year has gone and consider how many times you saw the doctor, went to the emergency room, or needed to buy medicine. If all you had was an annual checkup, you might want to consider moving to a high deductible plan. And related to that is the health savings account, or HSA. If you have a high deductible plan, you really need one of these, but even if you don't, they can be a good idea. You can put money away pre-tax for medical expenses. And unlike the FSA, the money continues to accumulate from year to year. If you max out on your retirement plans, your HSA can almost be like a supplemental IRA. Let's move to your portfolio. If you have any investments in taxable accounts that have gone down, you can sell them now and help offset any gains that you've had with the losses you take on those investments. You'll have to stay out of them for at least 30 days to avoid recapturing that. But if they're down this year, you're probably better off without them. Most likely, given that as I write this, the market is up a gob ton for the year, you may have some investments that have grown significantly. So significantly that they're now a bigger proportion of your portfolio than they should be. If that's the case, the risk in your portfolio has probably gone up. Now is a good time to rebalance before any significant adjustment can take place. Remember, it's not a question of if, but when the next downturn will happen. Markets are cyclic, so we know they go both up and down. Better to take some profits off the table now while times are good. The focus of a lot of year-end advice, of course, is tax planning. Whatever you want to take advantage of on your next tax return typically needs to be done before the end of the year. Most people take the standard deduction since they raised the standard deduction a couple of years ago. But if you itemize, now is the time to think about what deductible expenses make sense before year end. Are there charities you want to contribute to? If you're self-employed or if you have a side hustle, think about what business expenses you have coming up for the next few months. Can you move any of them into this year? Can you buy that computer you think you might need next year? Can you prepay any January expenses now? All of that will create deductions that you can use to reduce your taxable income. If you're an employee, this is a good time to take a look at your withholding. Did you make a tax payment or get a refund last year? If you did either of those, that in any significant amount, you may need to make an adjustment in your withholding. Remember, the ideal is to withhold just exactly the amount you're going to need. If you get a big tax refund every year, you may enjoy that, but keep in mind, you're making an interest-free loan to the government. You could probably make better use of the money on your own. If you have any questions about your taxes and don't have an accountant to work with, this could be a good time to find one. First, they may be able to give you a quick projection and let you know whether you've paid too much or too little. But second, it's probably a lot easier to find a couple accountants to interview this time of year. Once you need them, between February or April of next year, they're going to be neck deep in returns and may not have the time to talk with you. Finally, let's talk about a couple of retirement plan moves you can make. First is a tax move. Did you have a decline in income this year? Did you leave a job and have a little break before you started a new one? If so, you might want to consider converting some of your retirement savings from a traditional plan into a Roth IRA. If your income declines temporarily and puts you in a lower tax bracket, you want to make the most of that tax bracket because you can't get it back. Once the year is over, that's the last you'll have the opportunity to capture a lower tax bracket. Next year, if you make more money, you'll be back up in a higher tax bracket. Here's the difference between a traditional and a Roth IRA. In a traditional IRA, you put in money pre-tax, or you may actually contribute after tax and then take a deduction, but it comes out to the same thing. It compounds without being taxed between now and retirement. And then once you start drawing on it in retirement, it's taxed as income. With a Roth IRA, you put money in after tax. You get no deduction for it. It grows without taxation until you retire. But when you pull it out in retirement, it's tax-free. You get all that compounding and never have to pay tax on it. That could be huge. So the big question is whether you'll be in a higher tax bracket now or when you go to use it later. If you make a decent income, it could go either way. You might be in a higher bracket now or a higher bracket later. It depends on a lot of things like how many raises you'll get during your career and what the government decides to do with tax brackets. However, if you have a gap in income resulting in less taxable income this year, you may have an opportunity to take advantage of that. Let's say your income dropped temporarily. Maybe you took a new job and had a little break between that and your current gig. Maybe you're self-employed and your business was affected by the pandemic. Regardless, your income dropped, but only for this year. And when all is said and done, maybe you'd be in the 10 or 12% federal tax bracket. The next step up after 12%, where you may have been before, is 22%. That bracket is almost twice as high as the one before it. You can take money out of a traditional plan and convert it into a Roth. The amount you convert is taxable. It's counted as income now, but unlike just pulling money out of an IRA before retirement age, there's no penalty on it. So if you're in a lower bracket, it may make sense to convert enough to push you up to the top of that bracket. Any money you have in Roth IRA compounds without taxes to retirement and then comes out tax-free. You can take advantage of a low income tax bracket now and save a lot more money on taxes down the road. Finally, review how much you're putting away for retirement. You know that under the field of vision philosophy, we don't spend a lot of time setting specific goals for things that are way off in the future. Rather, we talk about what habits you need to develop to provide for a good future. In regard to retirement, if you're in your early 30s, you should be putting away 12 or 14% of your income to be confident that you can maintain that lifestyle when you get to be retirement age. If you're not contributing that much, or if you waited to get started, this is a good time to consider increasing how much you put away. Do you get a matching contribution into your 401k at work? If so, the absolute minimum you should put away is enough to maximize that match. Whatever you need to do with your household budget to be able to contribute at least that much is worth it. If you don't, it's like your employer is willing to give you a raise and you're politely turning them down. You're leaving money on the table. Once you get to the match, whether you continue to increase those deferrals or switch over to a Roth is a question for your financial planner. But the minimum is to make the most of what your employer is willing to do for you. That's it. A few smart moves you can make before the year end. Here's your 30-minute action list. Write down the ideas or download them as a free list and take a half an hour to run through them. Actually, it won't even take that long. But the moves you make now can pay you benefits for years to come. Again, get that free list at focusedwealthadvisors.com/10smart. That's focusedwealthadvisors.com/10smart for your free checklist. And thanks for joining me on 30-Minute Money.